Welcome to FounderLine, the show where we answer your questions about startups. I'm your host, Joe Beninato. Thank you for joining us today. It's great to have you all with us. Our goal with FounderLine is to provide a forum where people interested in startups can get their questions answered. So whether you're a startup founder thinking about starting a company or working on a challenging issue at your company, or an employee who's thinking about joining a startup company and you want to ask some questions about what it might be like to work in the startup company. Whatever it might be, we're here to answer your questions and see if we can help you out. This is a live show, and in order for it to work, we need to hear from you. So if you have a question, we'd love to hear from you. You can reach us many different ways. You can call us toll free. The number is 1-844-4FOUNDER. You can email help@founderline.com. Or you can tweet to our Twitter handle, that is @FounderLine. And with that, let's get started. Our guest today is Mark Goines, who's a very active angel investor. Mark and I have worked together a number of times over the years, and he's also worked with some very interesting companies, Mint, Nolo, WePay, and a number of others. Mark, welcome, and thank you for joining us.
Happy to be here with you, Joe.
Well, usually before we get started, I like to spend a few minutes just, asking you a few questions so the audience can get to know you a little bit. So, one of the things that I've always admired about you is you started out as an operator and moved on into the investing side. And, you've been at Wells Fargo, Charles Schwab, Intuit, a number of other places as well. And then you started doing a lot of investing in the financial startup space. So I'm curious, it's been since 2000 or so? How has that world of financial startups evolved in that time frame since you've been involved?
Oh my goodness, it's changed so dramatically. Actually my earliest days when I was working for Charles Schwab and Company, it took such a significant amount of investment to get the company going, not just from the viewpoint of paying salaries and spending dollars on marketing, but developing systems.
Yeah.
Charles Schwab didn't even have its own system. They bought a system from another broker dealer and then adapted it because it was the fastest way to market for them. And that even then, that was not a very easy system to manage.
Sure.
And so
was that like mainframe? Was that?
Yeah, mainframe.
Okay.
IBM 3090s. Our CEO at the time, Larry Stepsky, once commented that he was sitting at a meeting with the IBM guys and he was really curious why he was at this particular event. And they said, well, because you're buying more DASD than any one of our other customers. And he was a little worried about the inefficiency of that. But, those were the days when big data centers were required, millions of dollars of investment in infrastructure.
Yeah.
And so one example of change is just being able to go on Amazon, AWS, and you can start a company in 2 minutes and have your servers and systems up and running. You can use such easy to develop platform tools and have a consumer or small business facing software platform up in a matter of weeks.
Yeah.
And it took Schwab months just to find the system that it wanted to use, let alone building it out and getting it outfitted in their own data center and tens of millions of dollars. So starting is really comparatively easy, takes less capital and much faster.
And what about the investing side of that? Like, are we seeing accelerating activity in those areas, or what's happening there?
I think in part because it's so easy and inexpensive, relatively speaking, to start a company that there's lots of folks that believe they can do it, and so there's a lot more opportunities. Entrepreneurs can see how they can get up and running quickly. They don't have to raise a lot of capital for a few $100,000, if that. You can actually get a product to market.
Yeah.
So, because that barrier is so low, there's lots more interest in getting started and the risks are lower. And likewise, there's lots of investors. There's lots of guys that are very interested in becoming part of the startup world and putting $25,000, $50,000, $100,000 to work. You get 10 people together, you have $1 million, if you do a good job of early fundraising, and you have a company. The old days of venture capital where you needed to raise $5 to $10 million just to get out of the gate, put a lot of barriers to entry. So it's been a lot easier to get started, and I think great products come out of that ease of starting.
And a lot has changed in that funding world, just even in the last 5 years, let alone the last 15 years or so.
Or in the last 5 minutes. Oh my goodness.
I mean, so are you probably hear from all sorts of different companies, and I don't know if you're active on AngelList or you kind of look there, but like how do you go about finding interesting companies and then deciding which ones you're going to invest in? What's your process?
What I found works best for me is relying entirely on referrals from people that I know. And what I hope is that they also know the entrepreneur well enough that they can provide a personal reference. And I don't think that's any different than what some of the venture firms really rely on. It's their network.
Yeah.
And I, when I started actively doing angel investing in 2000, 2001, I was out at the conferences and, doing meetings and trying to meet people to find deals. And I found that very few of those that weren't introduced to me turned out to be very good. Because it's so hard to get to know the entrepreneur. And so I totally now rely on a referral of a friend or an acquaintance that seems to know the entrepreneur pretty well. I will take meetings with those who don't fit that criteria if they reach out to me. I don't follow AngelList very closely. I do see a few deals there, but only because they've already been referred to me by somebody else.
Yeah.
And I just find that it's much more effective to have some kind of a personal connection so that you can rely on that referral source's filtering of the person, because getting to know the team is my key criteria.
Yeah, no, that makes sense. And I feel similarly. When somebody I know well refers an opportunity, it sort of jumps ahead of other things where they've reached out directly, and there's probably a few diamonds in the rough as well, but that's a great filter for figuring that out.
I do find that some of the early stage funds will refer deals to me that they're looking at, that they've done a lot of diligence on, and I can rely a bit on that.
Yeah.
But those are still harder for me, and I do appreciate the fact that a first round or a soft tech VC or even some of the bigger funds like Greylock or August will ask me to look at something with them. And I will do that and have made some of those investments if I felt very compelled. But in those cases, I'm really relying on their filtering first before I'm willing to jump in. I take very few cold referrals.
All right. So if you want to get to Mark, you got to
get to know Joe.
Get to know me, and I might introduce you. So in the world of payment startups, we have lots of activity there, right? We've got Square and WePay and Stripe and a bunch of others, but it seems like all the focus is on Bitcoin, right? Like that's all anybody talks about is cryptocurrencies and what's the price of Bitcoin today. And so, what's your take on that whole sort of payments and financial company infrastructure right now? What are you seeing out there?
Well, what I find most interesting is that the bigger enterprises that have been dominant in payments for decades, like Chase and Bank of America and others, have a real aversion to taking risk, and they're not really great at leading edge ease of use innovation. So they focus their systems and methodologies around mitigating risk and getting customers that can go to scale with little risk.
Yep.
And these newer companies like Stripe or WePay have innovated on making it easier to get started so that you don't have to go through these huge screens of risk mitigation.
Yep.
But even Square, that has done very, very well at acquiring customers with that model, is struggling with the cost of risk, the fraud and all those things. It's a company that I think is going to struggle for some time, like PayPal did in its early days with managing the risk that is inherent in the payment system.
Yep.
And so one of the things that confuses me about Bitcoin is it seems like a pretty risky thing, although the protocol certainly promises not to be significantly risky and to mitigate the risk because of the blockchain management and all of that. But boy, we've seen some real faults and failures in the development of it. And so I think risk will continue to drive the growth of of payments. And so those companies that are able to onboard customers well without taking risk and make it easy for the customer, not having to go through a bunch of hoops so that they can get started with payments and yet meet the risk filtering the systems that are out there are going to be very, very interesting. And so the good news is there's a lot of new tools out there like Facebook and even Twitter to help you better manage and understand someone's background. You don't have to just rely on them giving you their bank account information or other details that are necessary to get started with payments. And so there's new data.
Yep.
And that's where I'm most intrigued, is how that new data will help payment companies scale rapidly.
That's great. And I heard Visa announced something like yesterday, but I didn't actually click on an article and see what it was. But it sounds like they're at least trying to take some steps in the right direction. I don't know if you
and the big payment providers like MasterCard and Visa and even Discover have tried a number of things to innovate, but I understand they suffer from the innovator's dilemma because they have these huge networks and trillions of dollars flowing through there, and a little eighth of a point can cost them $100 million, and so I think they have to be very, very careful. They don't have much room for innovation because the cost of a mistake is too high. Yeah. And the companies like Stripe and WePay, they can make mistakes and learn from them quickly, as PayPal did when they started, and then adjust as they go. So I'm still intrigued with the whole customer acquisition around risk model in payments. I think that's where scale will come from. Bitcoin hasn't achieved that, in my view, yet.
Yeah, makes sense. All right, well, why don't we take a few questions and see if we can help some people out.
Sure.
And before we get started, Scott Loftusness just tweeted that he's watching us. So, hey, Scott, hope you're doing well. Great to see you tweeting out there. So the first question is an email that came in from Ilya in London, and he has a question about bootstrapping. In the early days of a new startup, the founders may find themselves self-funding the business from personal savings and drawing no salary. If the business successfully makes it to a professional funding round, what norms are there for the founders to fairly recover some or all of that investment? For example, should founders calculate a market salary throughout the self-funding period and consider themselves to have loaned that amount to the business? Other mechanisms? Thanks. Great question. Actually.
It's a great question, and it's there's all kinds of models for that. My experience is that the founders are doing that kind of on their own nickel, and the value is really the equity value that they're creating.
Yeah.
And there's no direct calculation for that. It's let's say there are two founders, and they each want to own half of the company each when they get started, and so that sweat equity earns them that half. Now there are ways to convert the sweat equity into vesting value, but what happens in my experience in the first rounds that come in is there's this discussion about how much of that equity is actually yours versus how much of that equity is going to go onto a vesting schedule, even though you're not buying it, you own it, but it's really not fully yours unless you stay around for 24 months or 48 months or something like that.
Right.
And so what I've seen the dialogue around, not so much reimbursing for the cash in or any of that, but rather how do you accrue a percentage of the company from the sweat equity that you've put in, and that's the better dialogue.
Yeah, and cash is so critical in a startup. So, raising some money and then immediately paying back the founders for some time that they had put in doesn't make a lot of sense, right? Especially when you're raising these smaller 300K seed rounds or whatever it might be.
Right, and the cash out of an early stage company to a founder, other than in the form of salary, is usually frowned upon by new investors, especially in a very early stage company. Although, the flip side is in some of these later stage deals that we're seeing these days, 5 or 10% of the investments are going back to the founders, and so at some point it can be liquidity for you, but usually only after you've proven some traction.
Yeah, no, it makes sense.
And as an investor in startups, I really don't want my $100,000 going out to a founder. I want it going into a new technology hire or some marketing or something that's going to produce value beyond the founder's sweat equity. So I think for the most part, it's kind of lost, if you will.
Yeah.
It's sweat equity.
Yeah. Well, I think you just have to count on there's going to be 6 to 12 months where I'm not making a salary or very low salary after you raise some money. And then maybe your vesting schedule, as you mentioned, like instead of 4 years, you get credit for a year of that vesting,
exactly,
or whatever it might be, and that's the way to go. So, hope that helps out.
Great question.
Let's see. We have a tweet actually from At Ian Gertler, how will IoT, Internet of Things, impact your focus areas, Mark? He wrote down mobile apps, SaaS, financial, etc. So are you investing in that space? Are you looking at it, using it as a user? What's your take on that?
I certainly use it. What I've focused on, though, are the scaled platforms. And so it's clearly iOS and Android and your phone are becoming the center point for the things that I'm looking at and investing in. One of my companies, Life360, uses the GPS system to track where your family members are. But that's also becoming a connection platform where it can connect to your home. They've done a deal with ADT, for example, to help connect to home security systems so that you can remotely operate those from your phone. Or they've done a deal with BMW to connect it to your car. And so, if I'm seeing that my daughter needs to be picked up at school and I get a note from her, I can touch either the screen on my BMW system, which I happen to have, or on my phone, and my BMW navigation system will give me a map to wherever she is. And so there are some ways to integrate into the Internet of Things that I'm interested in, but the things themselves I haven't spent much time looking at.
So you're not investing in light bulb companies and those sorts of things right now?
No, I wish I was an investor in Nest, though. That was a pretty good Internet of Things.
Don't we all?
Yes.
Don't we all?
Congrats to the guys that did that.
Yeah.
And to the team.
So great. Let's go to our next question. This is an email this is one of our regulars, Larry in Yuba City. So he's emailed every show that we've had so far. So Larry says, I have serious doubts about alternative currencies. It sounds like you consider them risky. What role do you think alternative currencies like Bitcoin are likely to play? And do you think startups should be prepared to use them, or should they just stick with traditional currencies, dollars and euros?
So I think as a currency, it's fine as long as you convert it to the currency that you need. In other words, as a transaction medium, I think Bitcoin and others are fine. I'm very intrigued with the cryptocurrency transaction systems. And I think that what Bitcoin has built there is very, very valuable. The current access platforms are very expensive.
By the way, we should reveal on the show that you are Satoshi. You are the inventor.
I am not.
You are not? Oh, I thought we were going to get you.
No, sorry.
Okay.
Not coming out of that closet.
Darn.
Because I never went in it. So I think as an operator of a company, you need cash. And so, if you can take transactions in Bitcoin, I think that's fine, but I think you want to convert it to the currency that you need to run your company. There are others who love investing in Bitcoin and have large holdings in them, and they've done well. Certainly the guys at Rapid Capital have a big belief in that, and their companies have done well in that, and there are others that are doing well in that. But I think for a startup, it's really more about making sure that the transactions go smoothly. One of my concerns about Bitcoin for a startup is a transaction methodology is, what's the checkout process like? Is it going to be as quick and as easy as just taking a credit card or taking a PayPal payment? Because it's really about getting somebody through your purchase funnel.
Yeah.
That's what I would be more concerned about.
Without losing them, right?
Without losing them. And so I worry a little bit about what might happen in the back end, and I haven't seen any great data yet about whether you have a higher loss rate on those who select Bitcoin over the other currencies or payment options. And I think that's the thing to look at and make sure that you're getting the same buy-through. There are others who said, look, I'm opening up a market that I can't get access to because I'm selling internationally, I don't have a good payments method. Companies like Payoneer may offer you international settlement, but you have to get approved by them. And so if you aren't, maybe Bitcoin is an option to get started with for international payments until you can find another approved method.
All right. Larry, thanks for the question as always. Once again, we want to hear from you, so call us toll free. The number is 844-4FOUNDER. Email help@founderline.com or tweet to @founderline, and we'll see if we can help you out. Let's take a few more questions here. So we have an email from Michael. How do you decide where to invest? What are the key factors you're looking for? Business plan, team, idea. You mentioned something about team, earlier. So what's your take on that?
Well, I have certain categories that I look at.
Okay.
So obviously financial payments. I worked in the payments business. I worked in the banking category. I worked in the brokerage business. I worked on the tax category at Intuit when I ran the TurboTax business. So areas around those I know well. And so I can pretty quickly discern whether somebody's idea in that category may have some legs and some opportunity, because It's a category I know well, so I look at that. Education is a space I look at. Really small businesses is a space I look at. So innovations in small business that are helpful to small businesses.
Okay.
So if I know the category, but then team. And as I mentioned before, I want to be referred so that somebody kind of knows the person first. But I do spend a lot of time meeting with the people in the company to try and get to know them. Because almost every business that I've invested in has actually had an outcome in a different idea or a different play on the idea than the one I invested in. So the team has to be really good at pivoting, being flexible, listening to the market, adapting to that, and I look for those kinds of skills.
And so, like, would you say team is sort of your number one criteria for investing?
It's actually space and then team.
Space and then team.
Right,
Okay.
I have to have both. They're
Okay.
kind of equally weighted. If there's a space that I don't know anything about, somebody comes to me with, the invention of a new chip, I just don't know anything about it. I'm probably not going to do it.
Yeah.
In fact, I shouldn't say probably. I'm not going to do it. I'll leave that to guys who know stuff about chip, like you do.
Yeah.
Like you built some chip
Yeah.
businesses, right?
Well, that was a long time ago.
Yeah, but, you know this stuff better than I do.
And on the team, so you'll try and spend as much time as you can with the company. Like, is that typically like 3 hours, 8 hours, 12 hours? Like what?
Could be. It depends on how the referral came in and how things go when I get to meet them. And I will spend as much time as it takes for me to get comfortable. Some days, guys want an investment decision right away, and those are usually not investments that I make. I mean, I take my time and I want to get to know things.
Yeah.
And I can drive entrepreneurs crazy with questions, and part of that is getting to know their business plan, but part of that is getting to know them. How do they respond to questions that they hadn't thought about?
Yeah.
And what's that reaction like? So it's a process to get to know somebody. Maybe I'll take them to a ball game. I like to go see the Giants, and 4 or 5 hours together at a cold and windy night at AT&T Park can reveal a lot about somebody.
Exactly. Yeah, I always get nervous when people are trying to rush me through a decision very quickly, because it smells a little bit of desperation, and also you can tell if you eventually turn them down, like if they get pissed off about it, like, okay, well, that clearly wasn't the right thing and they were trying to rush you. So
Yeah.
I think it's good to
It does make me nervous, although deals move fast these days. I mean,
Yeah.
by the same token, and one of the reasons I stay in the spaces that I know is I can spot it pretty quickly, and I know it well enough. I've looked at a lot of companies in the category, and so when I see something that comes along, I can get good comfort with it quickly, and then it's just about getting to know the team. So I can move quickly if I can get comfortable with the team.
All right, sounds good. Let's see. We have an email here from Pascal. Angels seem to take a lot of risk. Why do they do it? So why do you angel invest? Like, is it some altruistic giving back thing? Is it because you're a greedy capitalist? Like, what are the reasons you're doing this actively now?
I'm a capitalist. I mean, I'm in it to make a good return on my investment. I do really enjoy working with early stage companies and young and aggressive teams, and so I get a lot out of that. I learn a lot from those who are innovating. That's fun, but I'm in it like any venture capitalist is in it for a really good return. And, I take a lot of risk and lose a bit of money on those deals that I take risks on, but that's made up for by, the deals that I get the 5, 10, 20x returns on.
Yeah.
And when those companies really start to scale, it's really fun to be a part of that and watch the entrepreneur's success. It's also very painful, though, to watch a company tailspin and go south. And so you got to take that as part of the game.
What's the split typically in your portfolio of companies that are taking off versus the ones that are kind of sitting doing nothing to those that are like nose diving right into the ground?
Right. So just in my current active portfolio, there's probably, call it 20% of the companies that are just knocking it out of the park.
Okay.
And maybe 5% of them are going to be 100x returns if they really keep going the way they're going.
Wow.
But I put relatively small dollar amounts in them. And then there's a similar percentage that are kind of the living dead or should be dead. And
Yes.
they're just hanging around, and it's clear they haven't got something to figure out, and they're not able to raise capital, and those will probably turn into either a sale or a write-off. The good news in a small angel portfolio, if the company hasn't taken in a lot of capital, is you can do an acqui-hire and get at least some of your money, if not all of your money, out. And so that's put a nice insurance policy underneath angel investing these days. And if you pick good teams, you can get that kind of outcome typically. And so those losses have been minimal for me. And then, there's the other sort of 60-ish% that haven't quite figured it out. They're either going to fall or they're going to grow, but it's too early to tell.
I see. All right, and that seems consistent with other numbers that are out there in terms of investments.
Yeah, but I do have some companies that have been in my portfolio for more than 10 years, and they're paying good dividends, and they're good businesses, but they're not, venture-like companies. They're not going to have liquidity events probably for some time to come, and I'm fine with that.
Yeah,
dividends are good.
Yeah, cash flow is not a bad thing, right? Okay, so. Now I'm going to take a minute to thank our sponsors. So, this show really wouldn't be possible without the support we get from our two amazing sponsors, Ustream and Orrick. I want to talk about Ustream. We met the team over there right before we started the show, and started talking with Brad, their CEO, and have been working with Alden and Warren over the past couple of months. And they've been really great to work with. Everything from getting us up and running, which was literally a 10 to 15 minute technology exercise, which was pretty amazing in my book, to doing remote shows from Europe, which we did recently, and continuing to support us as issues come up. So if you're thinking about doing something on the streaming side, whether you're going to start your own show or you have a meeting that you want to webcast or whatever it might be sure to go and talk to Ustream. They have great technology and really good support. You can find out more on their website. It's ustream.tv. In addition, I want to thank Orrick, which Mitch Zuklie is the chairman and the CEO there, and he'll be joining us shortly. Mitch and his team have done a great job for us, and I've worked with him a number of times over the years. I always tell people, when you're thinking about starting a company, you need to get a really good lawyer, not so much for the legal advice they're going to provide, which is very important, but just because they have seen so many different transactions and situations over the years that they can be helpful in. And all sorts of advisors are helpful, can help you work through issues as they come up. But your lawyer is going to be someone who's seen tons of financial transactions, investments. They've seen lots of M&A deals. They've seen partnerships with other companies, and they can really give you some great market data around, hey, that's not standard, or that is, or whatever it might be. So make sure you work with a great lawyer when you're starting your company. You can find out more about Orrick at their website. It's orrick.com, and I'm sure they'll help you out. So now it's time for our weekly Ask the Lawyer segment, and we love doing this because we get Mitch Zuklie to come on, and we cover a specific topic. So let's see if we've got Mitch on the line. Mitch, are you there today?
Hey, Joe. Glad to be here.
Welcome to the show once again. I think today's topic is a really interesting one because this comes up in the life of every startup, and it's around board meetings. So, if you're a funded startup and you've gotten to the point where you've pulled together a board, it's really important to find the right structure and the right rhythm to the board meetings, and make sure that time that you spend together is really effectively used. And so, Mitch, maybe you can start us off today with your thoughts. You've been in probably thousands of board meetings at this point. What are some best practices and ways to make sure that you're running a really good board meeting?
Thanks for asking, Joe. And, this is a question I think I probably get asked more by clients than almost any other. And I always say, I think the most important thing to do is think about what's the purpose of the board meeting. And, I think there are probably three. The first is to exercise the board's fiduciary duties, meaning that you have to show that you're paying attention, exercising your duty of care, learning about the core business decisions, and have some proof that you met. If there's ever, some question about that. So it's important to have them regularly scheduled, take minutes. Very simple. Then a much more important function, I think, besides the minimum bar of demonstrating you've met your duty, is to actually do something that's useful for the investors. Make sure that they understand the company's directions and its challenges, that they can look under the covers and figure out where they can provide support. And finally, there's a function around making sure the management team has a chance to report and that they can get feedback. It's a little bit like, making sure that you don't go too far without having a chance to see whether or not, if you're in a restaurant, you want to get some feedback as to whether the entree you're serving is well received by the customers. Now, I would say, in terms of practical advice, 3 things come out to me. The first is generally smaller boards are more effective. I don't know why. I think there's a lot of research that shows that groups of 5 tend to operate the best. I think that's one of the reasons that Navy SEALs and a bunch of other groups tend to have 5 people on them. But boards of around 5 seem to work really well. If they get bigger, it's a tougher dynamic, I think. Second thing I'd say is that you'd mentioned the word rhythm. Every company has its own rhythm. There are times where meeting frequently will be very important because you've got a pending deal or something. There are times where you're off developing and you need some space on your own. But in general, I think that companies that have meetings every other month tend to have a pretty good rhythm, and that rhythm tends to work for many companies. You don't have the management spending too much time preparing for the board meetings, but it's frequently enough that as things are coming up, the board has a chance to get together. And finally, I think shorter meetings tend to be better. I think that somehow, if you have a long meeting, people tend to talk more. It tends to be less organized, and I don't think that people get as much out of it. So, in general, I think if you can try to keep them pretty brief, they tend to be much more valuable than those that go on for a lengthy period of time. And that's that's some of what I found out on it. But again, it really depends a lot on the individual company, and I'd be very interested to hear what you guys think in terms of what's made board meetings that you've been around successful.
Yeah. So, Mark, you've been in your fair share of board meetings. What sorts of things have you seen that work well or don't work well?
Well, first, I want to say I think the things that Mitch said are all right up my level of advice. It's just smaller boards, relatively well-paced, every other month or so, and relatively short, just a few hours at most.
Like 2 hours? Is that a good target?
And I've been in some all-day meetings, and they do tend to drag on, but sometimes you need that if you're doing some big strategic shift. But I think those are all great bits of advice. For me, what I look for as a board member is the opportunity to help the team. And if I'm just getting a report on how we're doing and there aren't any strategic questions that they're asking, or there's no big decisions that they're looking for help on, I feel like I'm just like a reporter.
Yeah.
And trying to take down the news as opposed to being somebody who can be strategically helpful to the company. And so I appreciate meetings where the leadership team gives you a very good and quick update, but then says, and here's a couple of issues I'm struggling with. And even if in advance of the meeting, they share what those are and whatever data they may have around them, so that you can have a robust discussion about the company's strategy and find ways where you can be helpful to them. Yeah. But I think it's also, I've seen board meetings go over the line where members of the board are telling the team what to do. And I think that's too far. I think the team has to run the company and have to do well. The board's job is, in my view, largely to make sure the right team is there and that they're on strategy and all the fiduciary duties that Mitch talked about. But if you're telling the team what to do in the board meeting, you may not have the right team or the right board. And so I think being strategically helpful is the kind of pace of content that I want. I want to be able to see enough content to be able to be strategically helpful in the board meeting.
Yep, makes sense. And I remember, when I was CEO at a couple of companies, I always try and identify one sort of meaty topic that we were struggling with as a team and try and figure out, hey, here are some ideas about what we might do about it. What do you guys all think? And we'd provide some context around that, some reporting on how the business is going or what's going on with recruiting or whatever it might be, so that we could spend some time, usually, the bulk of the meeting on that issue, because you got all these smart people sitting around the table. Trying to get them engaged in a topic is great, but the flip side is what you said. You don't want them like chiming in on, I think it should be blue versus green, right? Like that is not, certainly if somebody has an opinion, they should let you know offline or something like that. But if you're using your board meetings to decide colors of the web interface or whatever it might be, then you have a major issue. So So Mitch, any...
I like orange myself.
You like orange? Yeah, absolutely. So Mitch, any closing thoughts or other suggestions?
No, other than there's an awful lot of blue out there.
Yeah, more every day, it seems like. Well, that's really helpful. And thanks for your time today, Mitch, and we'll talk to you again next week.
Total pleasure, Joe. Nice talking with you, Mark. Take care.
All right, take care. That was Mitch Zuklie from Orrick, and Mitch always does such a great job, like sort of thinking through the issues. It is such a great vantage point. One of the things that I thought of as we were closing out there is, the nature of some of these board meetings has changed a little bit with these party rounds where there's 50 to 100K from 10 to 15 different investors. I mean, there are cases where technically you have a board, maybe it's the two founders or whatever it is, but maybe in some of these funding rounds, like someone doesn't even take a board seat. So So what have you seen? You're sometimes on the board, sometimes not. What have you seen in those cases where it's kind of more of a community funding as opposed to venture firm X put in $2 million? What are some effective ways for CEOs to keep everybody up to date?
It's really a hard problem because there's this fine line between helping your investors understand what you're doing and getting them to help you.
Yes.
And you need to help them understand what you're doing so they can help you, and you want that from your investors. And then the other side of that line is where you're really giving out secrets or giving them information that maybe you don't want to be shared with anybody else, and are they really going to keep that to themselves? Within the boardroom, typically you can trust that, but sharing it with outside investors is a problem. I like a quarterly update from all of my companies, and I actually have a list of contact dates, and I go through every company once a quarter and send an email to the CEO if I'm not on the board to say, hey, how's it going? Send me the latest or whatever. Because the last thing I want is, 9 months in, somebody's going to say, oh, by the way, we're doing a round and I want you to put in 100K as a part of your pro rata. I said, well, but I don't know what you're doing. What are you doing?
What have you been doing for 9 months?
Those frequent updates kind of help me, and then I can offer them some help. The other thing as a co-founder of a company and a member of a lot of boards, I look as a co-founder to have the board members help me. What can I get them to do for me? What can I get my investors to do for me? And it's not as though I'm giving them an assignment that has a due date or anything, but I do look for their help. And it's part of a key criteria, I think, when you're bringing in investors is how can they help me? I'm not saying you have to make that an absolute criteria, but they can be helpful. And so how can they be helpful? Well, I don't know. You want to try and figure that out based upon who they are, but they can't be helpful unless they know what you're doing and how they can contribute to that. And so part of sending out a quarterly update is helping them help you.
Yep. No, that makes sense. And I used to try and do it monthly. There were some months where you end up missing because
I think that's too frequent, in my opinion.
Too much, huh?
I think it's just too much work on the founder. You want the founder focused on making the business go. And
but one of the hard things is, like for Tello, we had 15 investors, I think, in the Series A, in the A round. And there were some people who wanted sort of weekly sort of touch points, and there were others who, if they never heard from us again, they'd probably be okay with it, right? And
just send me a check when you're done.
And a big check. And so trying to find, like I felt guilty. Like, don't you guys want to know what's going on? And I'd always look for ways like, hey, can I tap that guy to help out somehow, or this woman, or whatever it might be. So you have this, you have a lot of responsibility on your shoulders. You've taken money from these people, and you want to do well with the money, and you also want them to feel involved. But sometimes it's hard. Like they're very radically different expectations, and trying to balance those is really hard.
And some angel investors are they have a career, and they're working in their company, and they really don't have time to read all this stuff, or they don't really want to spend time helping the company unless you specifically ask them for something that they can do. And so it's a burden on them to keep them informed. I'm pretty much a full-time investor, and so I want to be involved, and so I'm happy to get those updates. But the kind of updates I want are probably more robust than the guy who's a VP at AT&T and just put $50K in a company because he liked the guy. So I think there's an interesting balance there. One of the things that I do think AngelList is doing well is building out communication tools, and I think they are important.
Yep. No, that's a great point. All right, so let's make sure everybody knows how to contact us again. You can call us 1-844-4-FOUNDER. We need to get a phone call today. So somebody out there, make sure you give us a call. Email us, help@founderline.com, or tweet to @founderline. We definitely, the email and the tweets seem to be the most popular. And in fact, so our friend Scott Loftusness has tweeted to us. The question is for Mark, not for me. So I'm going to stay away from this one.
Scott always asks good questions, though.
How important is your gut instinct in judging people and teams? Do you rely more on your gut now than earlier?
Man, that's an interesting question. I have learned to trust my instincts, and I have always relied on them and how I get along with people and how well I communicate with them and they with me. It really comes down to how I feel about the quality of the communication and their integrity around that. So I think that's somewhat analytical, but it's really your gut on how well that's working. And I miss deals when I'm just not comfortable with the person. And I don't invest in them because I'm not comfortable, and sometimes those are great deals. But I'd rather be comfortable with the people that I'm dealing with. So I think I rely on it fairly consistently. I think the mistakes that I've made have largely been where I haven't had a good resource to help me evaluate the people, where I relied on somebody else's introduction and they maybe didn't know them so well. And so one of the key questions I ask is, how well do you know entrepreneur X? How long have you known them?
Yeah.
What business dealings have you had with them? Those are important to me.
Yeah.
It's a great question, Scott.
No, absolutely. And I mean, I found more and more as I've gone through the years that not listening to your gut, like your head might be telling you, oh, this is going to be a huge opportunity and whatever, but there's something telling you there's something wrong with this guy. Like, I'm not sure what it is and I can't put my finger on it, but not trusting that is a huge mistake in my opinion. And I have a hard time explaining it to people because not everyone has the same level of instinct around those things. But I can just tell like when something weird's going on, and sometimes you get some false readings. But
sure, and you miss deals because of that, and that's okay. There's a lot for me. There's plenty of things to choose from, and so I want a lot of things to line up before I invest.
You're a picky man.
Okay.
I think that's good. I think it's good.
I thought you were the picky guy in the room, but that's okay.
I'm definitely picky. That is definitely true. All right, another email here from Manuel. I know you are active in the world of education. What's happening in the education startup space? So I don't know if you've done a lot of investing there. You certainly are active, I know, with the Los Altos School Board and other things in the education space. So what about on the investment side?
There's a lot of really very, very interesting companies that are coming up, and with the implementation of new educational standards, there's a lot of thinking around opportunities for delivering curriculum in a more robust way. But I think more importantly, the impact of technology and the delivery of education and curriculum through technology, both in the classroom and home, has afforded significant new opportunities. It's no longer, here's the workbook, here's the textbook. It's now, go look this up online or take this quiz and see how you're doing. The Khan Academy is one of the most interesting innovations in the past few years, where they have really scaled this ability to both allow students to move themselves along, but more importantly, give teachers and other educators tools to help them evaluate how their class is doing. And it's the assessments in Khan Academy that are as valuable as the lessons themselves. And I find that very interesting.
But student assessments?
Yeah, so the students go through and they take the little quizzes on the topic area that they're working on. So if they're doing, they're trying to understand the Pythagorean theorem, and they take a couple of Sal's lectures on the Pythagorean theorem, a squared, b squared, whatever, and they learn how to do it and they do a few problems. Then they get quizzes. And the way they can show that they've mastered it is if they can get a certain number of those questions correct. And they look for 10 straight correct.
Okay.
And so the teachers who are assigning that work can look at all of the kids in their classroom and how they've done on those quizzes, and how long it took them to get to the number of correct, and which ones never really got there, and what areas they didn't fully understand. And then that allows the teacher to then go back to that student and help them explicitly with the areas where they're confused. I find that very interesting, very rich.
Well, they can,
and
at a
almost
glance,
real time.
They can see what's going on, right? Instead of spending the 2 hours grading the papers and saying, oh, I need to work with, Mr. Bill or whoever it is, right? And
right.
And so now they know, right?
And it allows the teacher to replan their next day, maybe in a way that gets them to cover that topic so that all the kids in the classroom come up to speed. But the more interesting thing about all of that is the amount of data that's now available about student performance. And how do you integrate all of that? And how do you help the teachers use that well? How do you help the students use that well so that they can improve their own performance?
Yeah.
And there's a lot of hubbub about how to use that while still protecting privacy and still giving the students the kind of insights that they need without, somehow revealing some personal information about the student that should not be revealed beyond the teacher-student relationship.
Yep.
And there's a couple of companies that are starting to work really hard at that and doing well. The Gates Foundation has also funded a couple of companies that got themselves into a lot of trouble around revealing too much data about the connection between the individual student and their performance. And so there's a lot of areas of opportunity for innovation in data management in education, in addition to curriculum delivery. So I'm pretty excited about those. I have 3 investments in the area. I won't give the names, but and I'm looking for more, but haven't found anything that is yet quite as compelling as the free lessons available on the Khan Academy, which is just an awesome service, and it's a not-for-profit, so it's not something one can invest in.
Yeah.
I wish I could.
Yeah, no, they seem to be doing great. I always wonder, and you have a very active role in Los Altos, so it's got to be challenging for these school districts and schools where they have limited budgets and they have lots of stuff going on, just to make sure the school's functions are running, to then go and evaluate a bunch of technologies and try and decide, okay, it's time to upgrade the XYZ system or whatever. So how are schools handling that now? Are they bringing in specific technologists to help with that stuff, or what's happening there?
Every district does it in a very different way. Just the most significant sea change in the past decade has been bringing laptops into the classroom and having wireless connection in the classroom. You think 10 years ago, that didn't exist.
Yeah.
Had to plug yourself in. And so that's a big investment in infrastructure, and it's been very challenging for school districts to keep up with that. And so you've had to allocate dollars towards that. We're very fortunate in Los Altos to get the benefit of donations from our families. But bond monies need to be raised to properly fund the delivery of technology into the classroom. One of the things we have done is we have taken our curriculum development group and split it into parts. And one part of our team is just training teachers on how to more effectively use technology in their classroom. Because if you think about the average teacher who's, say, 50-ish years old and hasn't really been a native to technology.
Yeah.
Facebook is a new thing for them. Just getting their laptop connected to a wireless network is a new experience for them. Our newer teachers who come in, they live that. They grew up with that. They were trained in that. And so we're having to train our teachers in how to be effective in using technology in their everyday life. And so that's an important investment, and I don't think we're well funded for it. I think what the state is doing around trying to fund that is important. But I think it's going to be some time before we see full penetration of even every student being able to have access to a laptop to be able to use Khan Academy in a classroom. That's very rare. It doesn't happen. Even in our own schools, we don't have a laptop per child.
Yep. No, it's a real challenge. Well, if you have an education startup, contact Mark or go through someone to contact Mark and see what happens. Okay, we have an email here from John. This is a good one. I'm not sure you're going to want to answer this. Can you name the best and worst VCs you've ever worked with? Why are they best or worst? So I'll let you decide how much or if any of that you want to answer, but I'm sure you worked with lots of people and you probably have some favorites and some not so favorites. But
So I prefer not to name names, but I will say that the best VCs are the ones who have been operators in companies and understand how hard it is to run a company and have an understanding of what it means to be a board member and not an operator. And so they've gone through the operating role, they can give good advice, but they're not trying to run the company from the boardroom. The worst are the ones who have that opposite background. They've just been investors, they've never run a company, and they're trying to run the company from the boardroom.
The backseat driver, we call that, right?
There you go. And so there are all types out there, but I prefer working with those who have had a fairly significant operating background.
I tell people I love the backseat driver board member who not only reaches from behind and grabs the steering wheel, but then puts their hand over your eyes as you're trying to navigate the car down the road. So those are my favorites. Avoid them at any cost if you can. All right, another email here from Richard. I need to hire many engineers for my startup. What is the best way to find them? So you've seen this, probably every company you work with is having challenges recruiting people.
It's really hard.
So what tricks have you seen that work well, or some tips we can help Richard out with here?
Well, networking is the best and easiest way, just through the engineers you have to friends that they have. One of the most interesting things that's worked pretty well for several of my companies is for them to run a demo day or run a codeathon or a hackathon or have some problem they're trying to solve. That's an interesting problem and a hard problem. And then they'll promote the event. They'll have an all-nighter or a 2-day thing.
Prizes.
And they have prizes and all that. But in that, they meet a lot of really interesting engineers.
And they hire people off of that?
They do, or they learn about other people who might be interested in working in their company from those who participated in it. And so, yes, hiring, and also it gets their reputation out into the technical community that they're a company that's interested in doing interesting innovations and sponsors programs to do that. So engineers like working on hard problems, important problems. And so giving them the opportunity to do that from the outside in exposes your company and its culture to that community. But being in that community is really hard. And so I think bringing that community to your company can be helpful.
All right. There you go. There's some good advice, Richard. I hope that helps out.
Hire a recruiter. That's the other thing.
Yeah. Well, what about that? I mean, finding good recruiters is almost as challenging as finding good employees. So, have you seen effective strategies around recruiters for hiring engineers? Like people who come in-house or outsource firms, or what have you seen?
In-house is very effective, but I think also making sure that your engineering team is contributing to the development community in a positive way, working on open source things or making contributions or solving hard problems out there, giving them some time to do that helps build your company's reputation among the development community that's concerned about that. The best developers, in my experience, are those who have a wide set of interests and want to solve a lot of different problems. And so being a participant in those communities where those problems are being solved in the open source world helps your reputation as a company. So it's another way to do it. So your engineers become your recruiters.
Yep. All right. Makes sense. Let's see. We've got another one here from Leslie. What is the number one reason you've seen companies fail? Is it founders disagreeing, lack of product market fit, inability to raise money? So think through your portfolio or other companies you've seen. Why do companies fail?
Well, it starts with product market fit not quite being there, and then pretty quickly turns into not enough money.
Because of the lack of product market fit.
That it could be cause, it could be effect. If you can raise a lot of money, you have the time to find product market fit. And so sometimes, and I don't subscribe to this theory, but raising a lot of money is really important because it gives you time. There's a downside to that, which is raising a lot of money doesn't necessarily engender the hunger, to find product market fit that you need because you have time. And so it's a little bit of a balance, but those are the two, and I think pretty equal factors. If you've got good product market fit, you're going to be able to find more money. And you have proof points around that. Customers are buying the product, using it, rating it highly, recommending it to their friends. Those are the things that get me as an investor interested in second and third stage companies. As an angel investor in early stage companies, you don't have that data. But it's the follow-on investors that really got to see that.
Yep. Well, and it is hard, if you're raising like a 300, 400K seed round and you bring in a small team of 4 or 5 people, you don't have a ton of time to mess around and to iterate multiple times and try and figure that out. So I think it's a great question. I think it's usually less about founders, disagreeing, although some of those disagreements from the team come out of struggling to find product market fit, right? And trying to oh, I think we should go do this. No, I think we should go do that. But I know it's something that would keep me up at night.
I can't recall a founder dispute killing a company that I've been involved in.
Yeah.
It may have occurred that I didn't see it, but I haven't seen it.
No, I think most
It does
of
happen. It does happen, but I haven't seen it.
Happen. I think most of it is around just trying to figure that out, and the clock is always ticking. And as you said, it's pretty rare for a company to raise way more money than they need. I mean, some people start off and they raise $10 million or 40 whatever $million, as we've seen in a couple of cases, and those usually don't turn out too well. But I could see one where they raise 2 or 3 million and they're still kind of have that frugal mindset and just banking an extra 6 months or whatever it might be. It's not a bad thing to do. So great question, Leslie. Let's see. We probably got time for one or two more here. So this one is from Thomas. I am running my own startup and finding it hard to raise capital. Do you have any advice on the best way to find the right investors? So this ties in with what we were just talking about. So what do you say to Thomas, who's working on his startup out there?
Well, ask the folks that believe in you to refer you to their friends that are investors. That's the first way. It's the way I rely on finding deal flow. But a lot of my friends who are starting companies that are in categories I don't know much about, so I'm not investing in, they've been successful with AngelList. They've been successful with Kickstarter campaigns. There's lots of ways to try if you have an interesting idea and a good way of expressing it, but you have to be able to express it well.
Yep. No, I think that's one of the most important things is being able to tell the story and just communicate where you want to take this thing. And I've heard some great stories recently about Uber and how they weren't really talking so much about revolutionizing the whole transportation industry. It was sort of this mindset of, okay, this thing is broken. Like there's a better way to do this.
Right.
And I think those situations are very compelling if you can find them. So
one interesting analog on that is I've heard if you are looking for capital, ask for advice. If you're looking for advice, ask for capital.
Yes, I believe that to be true. And Thomas, I know it gets hard out there when you're struggling through this sort of stuff. And if you have some advisors who are helping you out, that's another way to sort of relieve the stress a little bit. And maybe even involving your own team, and they've got to know that things are struggling, and it's kind of a lonely place when you're the CEO. So make sure you talk through it with people, and hopefully someone can help you out there. All right, I think we got time for one more, and this one is from Sharon. The question is, I'm considering joining a startup. What questions do I ask to really find out if they're doing well? So this is a really critical thing, right? And it's the same. It's analogous to when you're trying to decide if you're going to invest. How do you figure out if this is a company you want to invest in? So what about from the employee side? What sorts of things should they be looking at? What's important, do you think?
I think it's the same thing that the hiring manager is looking for. Is there a culture fit? Do we get along? Do we like each other? Do we want to spend 12, 20 hours a day together with this team? That to me is as important as anything. So if they're doing well or not is to me important, but more important is, do I want to be there? Do I want to hang out with these people? Do I really have a passion for this team or what they're doing? So that's first. And then second, I think you can ask some pretty straight questions about, how much capital have you raised? How much do you have in the bank? How's that going? What's the customer count look like if you're actually bringing in customers? How's the acquisition rate? How's the retention rate? The same kind of questions a good investor would ask of a company.
Yeah.
Those are fair questions for an employee. And I look for a culture of openness where that information is shared among the team. And so one of my key criteria when I joined every company that I've joined was how much did they really tell me about where they were? When I asked a question, they get a straight answer and an open answer, a complete answer.
Yeah.
And so I think you look for that, and a company that's not doing well has a tendency to keep that close, and that would worry me.
Absolutely. My favorite story here, Sharon, is I joined a company a number of years ago, and after a few weeks, one of the engineers came up to me and said, hey, how's this stock option stuff work? And I'm like, what do you mean? And he's like, well, I've been here 6 months. I still don't have any stock options. And it turns out the company, which had been funded by the founder and there were no professional investors involved, did not have a stock option plan. And yet all of us had offer letters that said, you're
going to get X shares or whatever, right?
So even, if you're very experienced, you can get fooled by this stuff sometime. And that was kind of a rare exception. But you just never know. So make sure you do your homework and check people out. I always like to do blind references, like just call friends of friends, and you find out very interesting things. And cases where I've gotten burned is usually when I didn't listen to one of those blind references. So,
well, and the thing to look for is the recent hires, why they joined, all of that. There can be this trend of wanting to be part of something that's momentum that's very valuable for a company, especially if it's hard to recruit as it is. Yep. Having momentum in recruiting is as important to the success of the company as how the product's doing.
Well, believe it or not, we are out of time. So, Mark, thanks for being such a great guest. If you want, you can follow Mark on Twitter. His handle is the very mysterious @Mark Goines. So be sure to follow him and send him some messages. Tune in next week for another episode of FounderLine. Our guest will be Carl Jacob, who is the founder and CEO of Hangtime and an active angel investor as well. He's a great guy and has lots of startup knowledge from all the companies that he's been involved with. That will be next Thursday at 5 p.m. Pacific time. Thank you once again to our fantastic sponsors, Ustream and Orrick.
And by the way, I want to disclose that I am an investor in Ustream, and thank you for the plug.
Oh, well, there you go. So I had no idea.
Seed investor.
Oh, that's great.
We'll see.
Don't forget to follow us on Twitter. Our handle is FounderLine. You can email questions during the week to help@founderline.com. You can also go to our website and you can subscribe to email updates, find out about previous episodes. All the videos are up there, and even subscribe to our podcast on iTunes. Thanks for watching. Here's to the crazy ones, and we'll see you again next week.